So are you thinking about buying your first rental investment? Or perhaps you're a seasoned investor and looking to expand your portfolio and want to make sure you're checking up and doing things the right way? Well, in this video, I'm going to cover 5 great questions that you absolutely should be asking if you're looking to invest in the London property market. Question number 1 is, what type of property do you actually want to invest in? Do you want to invest in residential property? Do you want to invest in commercial, or maybe even land? Each has a different dynamics and considerations. If you want to invest in residential, what type? Do you want, say, a single unit, a multiple unit? Do you want something that offers great yields or long-term appreciation? For some of my landlords, they want to invest as short-let Airbnb, which will typically offer a better yield, but may have different tax considerations and require more actual management, active management. Do you want to maximize yield? Then perhaps you're looking for something that needs a lot of work, and you'll be the best opportunity to improve the value by sweat equity or doing a regeneration or a renovation project. Here in the UK, some investors are focused on buying properties with short leases as a way to generate yield, or perhaps something that will earn higher rental income, such as their short-let investments, as I've mentioned. So it's really important that you ask yourself that first question of what type of investment and really what you want to achieve out of investing in the London property market. Next question is, well, how long do you want to actually hold that investment? Just like the stock market, timing is everything. If you're looking for a relatively short-term hold strategy, there may be higher rewards, but also typically higher risk. For example, some investors are happy to do renovation flips where they can buy the property, fix it up, do the work, and then sell it on for a profit. In this case, that investment timeline might be relatively short, or maybe, say, less than a year. With that, you just need to really do your homework so that you're factoring all the components that go into that strategy, including costs, unexpected delays, and then your exit strategy on the back end. And are you working with the right team of contractors throughout? Many investors in the early 2000s were buying properties, say, off plan with a 3 to 5 year strategy, saying, well, I'm going to buy this property before it's even built, so it's being sold directly from the developer. I might only have to put in a minimum amount of actual equity, say 5% of the purchase price, and then with the expectation that while that property is being built and the development's being built, the market's going to be appreciating and increasing to the point that 2 to 3 years later, when that property is now getting ready for completion, the value has increased so much that you could sell on your contract, pocket the difference, and never having actually had to raise those excess funds that you would need to actually, complete the purchase price. So a lot of people were doing that. Only problem was, one, developers started getting hip to that strategy, and instead of releasing all the units at the beginning, they started phasing the release of units, so your ability to purchase them. And so they kept more control, and then would also benefit from that market appreciation. So something, say, that's released in phase 2 is definitely going to probably price more expensively than something that was released in phase 1. The second problem with that strategy is that it was definitely dependent on an expectation that the market would be increasing by the time you were getting ready to sell that contract. But the market could shift, as we all know. And so I know I've sold for several clients who really get into that desperate situation where that completion date was nearing. They were going to have to purchase the property for what they had, agreed to in the beginning, but now the value had actually come down significantly less, and they were not going to be able to get a mortgage based on that higher value. And so now they were stuck having to come up with a lot more equity. So it was a risky strategy that paid off for quite a few people, but then as more and more people got into that strategy, it stopped paying off for many. But again, that was based on a strategy where they were taking, say, a 2 to 3 year expectation on the market and getting out of it. Thing to remember is that property is less liquid than other investments, so it's not so easy to get out of it in a pinch. Therefore, you need to make sure that if you are investing, that you have a clear and realistic time frame for your investment. Sometimes I speak to people who need to sell it by a certain date, but also achieve a certain price. And sometimes those two things just are incongruent, are not going to match up. So, can you afford to wait till the market perhaps can get to the point where it's giving you the price that you want? Or if you really need to sell right now, then you're going to have to accept the reality of what the market will bear in this current time frame. Question number 3 is, what area do you actually want to invest in? Whether it's London or a secondary market, location matters. You need to be familiar with that area and what may drive supply and demand. What are the employment and income trends? What are the area dynamics? For example, if you're in an area that's urban, parking may not be a big consideration. But what if you're not? If you will have to factor in something like parking, but also what other amenities that tenants might be really looking for. Area also matters when it may be time to what you can actually afford. If you're just starting out, you might want to be in a place where the entry purchase price is much lower, but if you're more established and comfortable with investing and more funds at your disposal, you might want to come into more central London and take that long-term strategy if you believe, and historically as it's been demonstrated, that property market is going to appreciate some of the lesser secondary and tertiary markets. Question number 4, who is the team that will be supporting you? If you're going to successfully invest, you need the right partners around and there to support you. First of all, you need a trustworthy agent who can help you identify the right opportunities that fit your investment criteria. You'll also need a great tax advisor to help you clearly calculate the tax implications of your investment. One of the key things investors are looking at is whether to invest in their own name or via a company structure if it's a high value transaction. There's also tax considerations for each ownership structure that could be further impacted by the number of properties you plan to invest. So it's making sure you have that right tax advisor who will help you understand all those issues. Obviously, if you're going to need debt, you're going to need the right mortgage advisor to make sure that you're getting the best loan terms that are out in the market. You'll also need a property solicitor, financial advisor, surveyor, insurance agent, contractor, handyman, property manager, and even cleaner. So make sure you keep those in mind. And finally, for question 5 is, what are the operating expenses you will incur? This is so important. It will start with your interest on your mortgage if you do have a mortgage, which is another reason why that mortgage advisor is so important. Here in the UK, fixed rate mortgages are typically for 2, 3, or 5 years and not much longer than that. So have you stress tested your expenses to see what happens if interest rates go up by 1%? It might sound unlikely, but we are at historical lows, so rates really only have one way to go, and that's up. So you need to make sure that your rental income can, really cover what your expenses are actually going to be, and not just necessarily under the best case scenarios. Other operating expenses might include service charges, ground rent, and insurance. Beyond that, you should set funds aside for general ongoing maintenance and repairs, but also for capital improvements, if it's an older property that might need something like a new roof over time. So those are the 5 questions that I think you should be asking before you invest in property, whether it's here in London or anywhere else. I hope you found this video very useful. One of my favorite sayings is, you make your money on the buy, meaning the deal has to stack up on the front end, not based on rosy assumptions of what may happen in the future. So make sure you do your homework, check out all the key components, use the 5 questions as a great checklist, read, follow others, ask great questions, and make sure you do all that before making that first investment. And if you're thinking of investing in the London property market, please reach out. I work with lots of international investors to make sure that I can be that trusted advisor that they need, and also connect them with the right experts throughout that journey. I'll see you in the next video.
Thanks so much for watching. Make sure to check out the other videos on my YouTube channel where I share great things about the London property market and living in this incredible city. So that's Arinzeh with Onyx Property Team and Keller Williams. Bye for now.